My name is Miles Harper, and I will be your moderator. And I'd like to introduce, to start with, I will get to our panelists, Kelly and Larry, in just a minute, but I wanted to go through a few things for housekeeping before we get started. Number one, there is no CPE credits available for this seminar. There may be in the future, but for right now, we have not set up to do that. If you are an attendee today, you will automatically receive a recording of the webinar, so look for that soon. And along the way, if you have questions, I will consolidate those questions, and for the most part, we'll go over them at the end unless we can find a way to squeeze one in along the way, but we are trying to work through all of our material within the time allotted, and it should be fine. Let me start by introducing our panelists, Kelly and Larry. Kelly is a construction partner with our firm. Larry is head of the construction practice for our group. Kelly is from Florida State University in Tallahassee. Larry is from Mississippi State in Starkville. Kelly enjoys spending time with her family. She loves to get out on the water. She loves to travel. Larry, on the other hand, loves to spend time with his family, and of course, being from the great state of Mississippi, loves sports, particularly football, and particularly his Mississippi State Bulldogs. Once again, my name is Miles Harper. I'm your moderator. I am from the Houston office. I'm a construction tax partner in Houston. I went to Baylor. Love my Baylor Bears, although we've taken it on the chin here lately. I also love spending time with my family and getting outside whenever I can. So, with those introductions, I will hand it over to Larry and Kelly, and we will go through some materials, and I hope you have a very enjoyable webinar, and it's very informative for you.
Well, to start with, we're first going to take a poll question. So let's take a look at that. If you can
I'm sorry, Larry, go ahead.
I was just going to read the question. What does the surety company stress most in determining your bonding capacity? Working capital, discounted working capital, net income, cash position, or none of the above?
We will collect your information, and we will get back to you very quickly with our responses as we go ahead and start going through the material.
Do we have everyone's responses in? Okay, so it looks like most of you have said working capital. We're going to start with these clues for contractor goals. And the reason for this is that these goals are presented so that you know how the users of your financial statements are reading them, and so that your company's success is not limited or held back from not knowing what you should be striving for, or what your goals or benchmarks should be. So we're going to go through a few rules of thumb that will help you and your company. Most users of the financial statements of contractor companies are, of course, the surety company or the bankers. So the first thing we're going to go is discounted working capital. In my experience, discounted working capital is the #1 thing in determining a bonding capacity for a construction contractor. Generally speaking, you're going to get somewhere between 10 or 20 times your discounted working capital. The thing about discounted working capital is it's different. True working capital from a CPA's point of view is current assets less current liabilities. But in the surety world, they take a few things and adjust them. So some of these things that they're going to take out, which will potentially reduce your working capital and lower your bonding capacity, are your aged receivables over 90 days old. They also are going, the reason for this is because they're going to doubt collections. Now, I know some of my construction contractors have agings that are a lot longer than that, and the reason for this is that they are, depending on if you're a subcontractor and you may have a notoriously slow general contractor in your area, or a very large customer, whether it be the state or something else, that will that takes more time to pay. Those are generally known in the area in which you operate, and so the surety companies will take that into consideration. But by general rule, any receivables over 90 days old become doubtful, and they're going to look at that and discount those. They're also going to discount certain inventories. Inventories are, for a construction company, are often composed of building materials that were not used at the job site and therefore were sent back to be logged into inventory. Well, they may be very specific to a certain job, and it may look doubtful, depending on what type of contractor you are, that those can be used on any future contracts. Prepaid expenses. Prepaid insurance is usually the number one thing they're going to throw that out. That's not going to turn to cash just because you paid something, and it may have some economic life from our point of view from GAAP. The surety company knows you're not going to get anything back for that, so they're going to throw that out in calculating your discounted working capital. Deferred tax assets, if you're a C Corp, they throw out every time, although on the flip side, if you have a deferred tax liability, they leave that one in there. So, as always, if it's to your benefit, you're going to lose it, and if it's not, if it's possibly to your detriment, they're going to keep it. The other thing they'll look at is if you are a pass-through entity, which a lot of companies are now, either an S Corp or an LLC, they know that the company is going to have to take out cash for its owners, for its shareholders, to pay their taxes, since the company's income is being taxed on the personal returns. So they generally will take an estimate of this number based on your net income and deduct that from your working capital. One thing that's not on the slides that often they add in, though, is your cash value of your life insurance policies. Because that cash is readily available, they will add that back to the discounted working capital. In addition, you can see on here that cash receivables under billing should be greater than your accounts payable and your over billings. And if you think about it, that makes a lot of sense. If your payables and your over billings exceed those things that are turning to cash the most quickly, that's a very bad sign. So try to always strive for your receivables to be higher than your payables, that if you have over billings, that your cash is equal to that or exceeds that, so that you will not be limited as you are trying to do business and obtain bonding. The next thing we're going to look at is equity. And equity is synonymous for net worth. Sometimes they call it capital, and it's the owner's investment in the company. It's probably the second biggest factor in determining, your bonding capacity, your credit worthiness. The reason for this is because the sureties and the bankers, they want you to have skin in the game. As we would want if we were in their position. They want to see that you have left money in, that you're not stripping out all the profits and any available cash, so that your company can finance its own projects, so that the owners have skin in the game to make this a success. The one thing about equity is generally it's your stockholders' equity section, your members' equity section if you're an LLC, on your balance sheet of your financial statements, but the bonding company will make certain adjustments to this equity number. One thing they'll do is they reduce it by owner or other related party receivables, prepaid expenses, intangibles such as goodwills, trademarks, those type things. And they will also reduce it by off-balance sheet tax liabilities if it's an S Corp or an LLC. So equity is a very big and important number on your financial statements, and this next slide will show us why. In order to calculate your debt-to-equity ratios, of course, your equity is a component of that. Debt-to-equity ratios are always looked at so that you can't borrow your way into working capital. You can't borrow your working capital, and also to make sure the company doesn't get over leveraged. You don't want to create anything with debt. In certain industries, this is a little harder than other ones. If you're a heavy highway guy, a road builder, site builder, the yellow equipment is high, and therefore you end up with a lot of debt. But you need to keep an eye on this. The other thing that happened after the 2008 recession was a lot of significant losses that companies were sustaining were affecting their equity, and where they had acceptable debt-to-equity ratios in the past, when equity dropped, of course, these numbers got out of line. what you want is the way that the goal you should be attaining is to have an interest-bearing debt to equity of no more than 1 to 1. You don't want that to exceed that, and you actually want it to be lower so that you have some room in case you sustain a heavy loss and that equity number ties. So your interest-bearing debt would be your bank debt, your capital leases, those type things. You want to make sure that those are staying fairly in line with your equity. If you have a reduction in equity, hopefully you can also reduce that, although sometimes it doesn't work that way. The other thing you want to ensure is that your total debt to equity is less than 3 to 1. So you don't want, when you throw in your accounts payable, your overbillings, all your accrued taxes, you want those to stay around the 3 to 1 ratio or less. So the lower it is, the better credit you will have with the surety company, with the bankers, and the users of your financials. It shows a healthier company. As I said, this is a little bit more of a challenge for your heavy highway guys. The next thing is a strong cash position. It's no doubt cash is king in the construction industry. In my experience, I've seen 2 different things that can kill a contractor. One is a terrible catastrophic loss on a job, either from a bad bid or bad subs or whatever went on. And the other one is simply running out of cash. For this reason, if you are the owner of a construction company, you don't want to strip out all of the cash to invest in non-productive assets. And these are things that often my construction clients love the most: farms, hunting camps, RVs, boats. The surety company does not look favorably upon that, and it shows a trend. Even if your company is healthy, it shows them that it makes them nervous. They like to see that you're keeping your business, you're trying to run it to make the maximum profits, and you're using your personal money for those things, not the company money. They also don't want to see the construction company being used as an investment company, either by buying non-publicly traded investments or publicly traded investments. For this reason, when they're calculated discounting working capital, they generally, if you have a large investment in marketable securities, but particularly equity, they'll discount that because they want to discourage you from making those type of investments. The one exception I've seen is with the Departments of Transportation in Mississippi, at least, they often allow you to have a municipal bond or another type of state bond in lieu of retainage. But your goal that you're shooting for here is you want your cash to be greater than 5% of your annual revenue. That's a great goal to shoot for. You also, as I said in the previous slide, you want your cash to be greater than your overbillings and your bank line of credit. You want a bank line of credit of at least 5% of your annual revenue, if possible. Most of my contractor clients are extremely adverse to debt. But if you have a line of credit, get a line of credit. If you don't have one, if you have one, use it periodically, pay it off, even if you don't need it, to build up that payment history, because as we know, those with credit can get more and more if you have a good payment history versus trying to get it when you need it. So when times are good, draft down on your line of credit, pay it back, and every time it comes up for renewal, push your bankers to give you the biggest increase that you can get, and let's keep that line of credit going, keep it as high as we can possibly get it, so that if something happens and you all of a sudden have a bad customer on a really large job for you, or something else catastrophic, you have availability to pay your bills and aren't at risk of running out of cash. The reason for this is one of the leading indicators of the risk of bankruptcy is having limited availability of cash. So that's why they really watch this. The next thing we're going to talk about is cash flow, which is a little bit different. This is where you're managing your receivables. A contractor should always bill aggressively according to their contract terms. You want to, if you can get a 10% mobilization fee and you've done no work, you should try to do it, because the sooner you get the bill in, the sooner you will collect it under normal circumstances. So we want you to bill aggressively. Depending on the GC or if you're a GC or if you're a sub, your collections may be a little bit different, but the goal is a turnover of your receivables in 30 to 60 days. I know a lot of times subs are not in the driver's seat and they're having to depend on those general contractors who seem to hold your money maybe longer than you think they should. However, that's what your goal should be, is this 30 to 60 day turnover. The other one is retainage. You want your retainage to turn over in 90 days or less. I was at a very successful contractor client of mine the other day, and he said their retainage turned over anywhere from 30 days to 2 years. I know that a lot of time this is a very variable thing on your retention, but the squeaky wheel is going to get the grease. So be aggressive and start calling and trying to collect your receivables as quickly as you can, and work with those customers and GCs that are most likely to pay you in the way you need to get paid. The next thing we're going to talk about is underbillings. I mean, you really don't want a lot of underbillings. There's no absolutes in anything. However, underbillings are generally examined, particularly depending on, there's maybe a few industries where if they do a lot of cost plus work, you don't have an option here. But in general, what you want to do is be overbilled so that your customer is financing the construction project. So bill when you can, because the problem with underbillings is they are often indicative that there are unapproved change orders that are out there. And once they sit out there for a while and your underbilling grows and grows, it becomes very doubtful that it is going to be approved. And the way the sureties are going to look at that is there's going to be, the contract is stated at a higher amount than it actually is. The other thing is it's indicative of a lost job, that there's problems on the job, that there's profit fade on the job, that there's either the job is going to go into a litigation or a claim situation. Oftentimes, when a job starts going bad, the customer immediately stops paying the bills, because if they're going to be in a claim or they're going to have a back charge against you, they want some leverage there. So even if you have a contract that is absolutely cut and dry, that you're entitled to $1 million, if they're holding your money, they're trying to get leverage over you to make sure that what they want is what happens. So underbillings are something you should shoot to have a minimal amount of, if any, unless the situation is absolutely requires it. The next goal that we're going to talk about is overhead. What I often see in my market is when a contractor has been very successful for several years in a row, whereas they may have one time been very careful about allowing their overhead to creep up, when you're flush with cash and everything's good, they start getting loose with things. And the problem is with construction, it follows the economy a lot of times, and there's always going to be ups and downs. Well, when you have a downturn and you don't have that good year, it's very hard to put the genie back in the bottle. So you need to stay on top of overhead all the time. The thing that I hear most from sureties is they like very consistent overhead. They don't want overhead being, let's say $700,000 one year and $300,000 the next. One thing that often is making that change occur is your bonuses to your employees and your owners. On your financial statements, these should generally be presented not as overhead, but as another income expense item, because that way it keeps things that are dependent on the profitability of the year out of true overhead. Overhead should be what it's going to take whether you have one job or 50 jobs. So be sure to keep an eye on that. An overriding goal that we see is your overhead percentage should be somewhere between 2 to 5% of your revenues. So try to make sure that you stay in line, that you keep it consistent, and that even when things are going great, that you don't let it creep out of control. The next thing we want to see is a surety doesn't want to see any kind of significant profit gain or profit fade. They really would like everything to stay about within 10% of the original gross profit percentage. Now, that's not to say that that can happen in every instance. There's always something that can go wrong, and in construction, there's always, one bad job or something that's hampered you. But it's a good standard practice to stay on top of your profits, to know where you are. Good contractors know how their jobs are performing, and they don't have a lot of this. And most of my really good exceptional contractors that I see generally have a little bit of profit gain. They try to fairly state them, but if you have a history of profit gains instead of profit fades, the surety company is going to have a lot more confidence that you know how to bid your jobs, how to manage your jobs, that you know where they are, and that gives them, they don't like to see big swings from your internal financial statements to your year-end financial statements. The other thing to watch out for is, I have certain contractors that don't, have great pride that they've never had a loss. You don't want to if you have a loss, you have a loss. And if you notice, that's not something that we talk about a lot in these goals benchmarks, because sometimes that just occurs. But I have had contractors who try to bury that loss and inflate their profits on their jobs so that they can say they've never had a loss. The problem with that is when the job is complete and there is a loss, you not only have to take the loss in the year that you're showing it, you also have to show deduct out the incorrectly reported profits from the previous year. So this is just not a good practice to do. It also, if the surety companies and bankers lose faith in you being able to generate accurate in-house financials, what they often do is start requiring you to hire us, the CPAs, to prepare everything that they see, which of course increase your costs, increase your overhead, and makes you a less profitable company. So be sure that you're always conservative on your gross profits and you try your best to show profit gains. And that's what I have right now. We're going to go to another poll question, and I'm going to turn it back over to Miles.
Thank you, guys. Larry, thank you very much. There was a number of questions that came in, but like I said, we will go over those at the end of the presentation. For our next poll, we'd like you to look at, in your experience, the main cause of profit fade on a contract is, and you have 5 choices, and we'd like you to go ahead and answer that now. And it is very clear that a bad estimate at the time the contract is awarded is far and away the biggest reason for a profit fade on a contract. So with that, we will move on. Kelly?
All right. Yeah, I'm going to go over profit fade with you and give you some different ways that you can prevent it. Many construction companies suffer from a condition called profit fade. It occurs when the profit from a job is less than anticipated, usually due to some kind of increased cost. There are 3 steps to avoid it. You can identify suspected causes early, quantify the worst case scenario so that you are prepared, and mitigate those causes and reverse this trend. First, you can prevent profit fade by identifying the suspected causes early, such as incomplete or overly optimistic cost estimates that are too low, underestimated labor or equipment rates, change orders that come up during the job that are not billable, supplier or subcontractor performance that is poor or not acceptable, inadequate field supervision or training, and weather, which we all know cannot be controlled. You can also prevent profit fade by surveying your project. First, make sure that you start with a budget that is based on the actual bid provided. You can integrate bidding and job costing systems so that variances in your costs can be monitored. Use job cost phase codes for each phase of the job and have a common understanding of their meaning. Report labor and equipment usage daily so that it is tracked and monitored. And report your completed work daily. You can further survey your project by allocating the cost consistently throughout the job. Use a purchase order system. Track equipment utilization by each piece of equipment. Produce monthly job profitability reports. And have project managers that forecast the cost to complete the job on a regular basis so that you can stay up to date on the job, and then discuss the reliability of any profit fade estimates. forecasting is so important to avoid profit fade, and it can have an impact on your financial statements. Profit fade is a fact of life for contractors. Sometimes the estimated profit on projects included in the financial statements can be misleading because they may not be up to date. And differences in the manner of reporting events causing profit fade can have a major impact on your financial statements. So let's look at a few examples here. Here I'm going to show you there are 3 graphs that illustrate the effects of the same event causing profit fade. So in graph A, this manager refuses to believe that the overall profitability on the job is at risk after there has been a profit impacting event. This results in a sudden profit fade and a surprise ending to the job. We do not want that. In graph B, this shows a trend of increasing profit fade. This manager believes that the profit is reduced only by the amount lost to the date of discovery, and they take no steps to stem or fix the problem going forward. In graph C, this is conservative, and this shows the proper application of GAAP. The estimated profit is reduced as soon as this event occurs. In this graph, the contractor sees the profit fade coming and does what it takes to prevent the profit fade. They may dedicate their best resources to clear up the profit fade, or even sacrifice their personal time to help salvage the job. This is what we want to see. Finally, I'm going to give you some clues to success to avoid profit fade altogether. First, project managers are key to understanding all the factors involved, and they have top-of-mind knowledge of the project status on an ongoing basis. Accurate job cost reports are essential. You must look at factors beyond just your cash position, and you need to be able to explain any underbilling. Finally, accurate forecasts raise creditability with bankers and surety agents and are imperative to avoid profit fade. All right, Miles, back to you.
Okay. All right, thank you. And before our last section, we have another poll for you. What collection method works best for your company? Mail statements, litigation threats, frequent phone calls, a visit from a hitman. We do not offer that service yet in Houston, or stopping work. And it is once again overwhelmingly clear that frequent phone calls are what seems to be the best way of following up on potential collection issues. So thank you for that, and we'll turn it back over to Larry.
Yeah, okay. Well, the next thing we're going to go over is some clues to getting paid. None of these are rocket science, but it's best if you start to think about this and you put a policy in place in your company. That's the most important thing, is for your company to end up with a reputation that when we do work, we expect to get paid, and that they know that you are going to be doing the follow-up to make sure that it happens. So the first problem with cash flow is often, slow paying clients. I know that in my particular market area, there are certain GCs that are notorious for, holding money for a while, and even their owners will talk about how they held other people's money. The other problem is the state of Mississippi's Bureau of Building and Grounds is notoriously slow in paying their bills. So, your question there is, potentially, what can you do if you must work with these giants in your area, that if you don't do work with them, that you're severely hurting your company? So you want to definitely do the front end work on deciding when to provide credit and to whom to provide credit. You want to determine the credit worthiness of your clients. It can be things simple. Ask for references. Ask for the company you're working for's financials. Ask a sub that's worked for the company, or ask a GC that's used that company for a sub, and find out their reputation and do they pay their bills. Because just like you want to collect your money, you want to make sure that the people who are working for you are paying their suppliers and their subs. So you definitely want to determine the credit worthiness of your clients. One way to do this is to obtain credit reports. There's no way to eliminate risk completely, but this will help. You can ask for credit reports from Dun & Bradstreet, which is dub.com, Experian Commercial, or Cortera. These are easy to obtain. There is a problem oftentimes with having current information. I have noticed that it seems that some of these services tend to have their most current information may be a couple of years old, which is very problematic. But generally in the area, if you know someone who doesn't have a good reputation, the best thing to do is try to avoid them. You're probably not going to be the exception to the rule. So generally in the construction area, if you talk to other people, they will tell you if there is a bad customer of some sort. Examine the credit report. You want to make sure that your client pays on time and doesn't have a reputation for always paying late, and these credit reports will show that information to you. Is the payment trend positive or negative showing up on these credit reports? How big are the client's vendor credit lines? Often if you don't pay your bill, you start immediately getting reduced on your available credit. So if there's some trend there, are there tax liens and other filings filed against the potential client? If there's liens and lawsuits, you may just want to stay away from that customer, because even clients that have historically been very good at paying may have hit a downturn where this is indicative of a new trend, and you may want to just be cautious or do other homework to make sure that you've alleviated your worries. One thing that is necessary is to, as I said at the start, and I've said in one of the earlier slides, is to get something in place for a cash collection system in your company. How is this going to work? I mean, first thing you always want to do is you want to proper and timely bill. You don't want to do anything that's going to hold up a bill. As I said earlier, if you can do a 10% mobilization, do it. Whatever you can do to increase your billing, and make sure that you monitor once the receivables go out. Monitor your aging list constantly, because if you get a reputation for letting it go and not calling about it, then they're going to let that age out farther. The squeaky wheel is going to get the grease. You want aggressive follow-up. If you're going to leave it, sometimes owners want to leave it to someone else because no one likes to call about collections, but sometimes it's necessary for the owners or someone else, the project managers, to follow up on these collections. The project managers, if they're on site and they're dealing the most with the client, they may be the best ones to make sure that all of these are happening. But sometimes it is necessary to say at a certain level, the owner will step in and start calling. So 7 steps to getting paid on time is, number 1, understand your contract terms. Make sure that you're following the letter of the contract that you've signed so that you will get this, because any deviation will cause delay. And examples of this, if it requires that your pay applications have a notary, make sure they're notarized. If they have to be submitted on a certain day of the month, make sure they're submitted on a certain day of the month. You want to follow those clauses so that there is no reason that your customer can say that they're not going to pay you because you didn't follow the contract. Often what I've seen is sometimes contractors will vary from this, and of course the bill gets kicked back. Well, if it gets kicked back with changes or corrections, or you forgot to notarize, that's all that is delaying when you're going to actually receive your money. As we talked about in an earlier slide, extend the credit to only customers who deserve it. If at all possible, if you know someone's late paying, if you are not prepared to float their receivables for 90 days and finance their project, or longer, 90 days or longer, and finance their project, just try to stay away from them. Or at the point that your company is strong enough to, or has built up a reputation to work with others, try to avoid those customers that are difficult. Use an acceptance letter for all deliverables. Make sure that that you can have documentation that your billings were received, everything that you've done was received. This is also very useful if you go to a dispute. A lot of times, if people are holding your money for long times, once again, this is indicative that there's a problem on the job, and it may be going to a claim or some type of litigation, arbitration. Documentation is key in this. The more that you have that you followed the terms of the contract, but yet they're not paying you, then that is going to be valuable. Submitting the invoices according to procedure. If they're supposed to go to a certain person, whatever the procedure, in most companies, the project manager, it starts with the invoice to approve them, code them to the different phases and the different components of the job. So make sure that your invoices are submitted according to the procedure. Once again, monitor your invoice aging reports. I can't stress this often enough. At the point something starts going beyond if you have done work repeatedly with the customer and it's farther out than their usual payment or farther out than you're willing to accept, start the procedures in place. Do we first start with a phone call? Do we start with a statement? However it is, and follow them on every job. Handle collections the right way. Have those set procedures that's in your company so that everyone in the industry that you work with will know what your procedures are, and you will develop that reputation. Call every 15 days until you're paid. At a certain point, once you start calling, don't call just every 30 days. Call more often than that and let them know that you're going to be aggressively following up. After 90 days, if the client is not able to pay, you've got pretty much two alternatives: either work out some type of payment plan or using a collection attorney. No one likes to go to litigation. This always seems to create problems and cost to you. However, there is a reason for this. And as I said, at the point that you start seeing these delays, document. I know in certain states you can place a lien on the project. So the windows for those are very well defined. So make sure you consult with your attorney, and if a lien needs to be filed on a project, that it's filed in the way that it needs to be filed. And handle your disputes quickly and as professionally as possible so that is your reputation in the industry. And once again, I can't stress enough to document everything in case things get away from you. And that is all I have on that. So I will turn it back over to Miles again.
Thank you, guys. Before we let you go, we've got time for a couple of questions, and I've been collecting them along the way. Kelly, I believe this first one is for you. And the question is, how do you define profit fade? Is it actual profit dollars compared to the original estimated profit dollars, or actual profit dollars compared to current estimated profit dollars, which includes change orders?
It is, I'm sorry, can you repeat it? It's from the original actual bid.
So it does not include, say, current change orders?
Correct.
I'm sorry.
Go ahead, Larry.
What I was going to say, in our market, generally how it's looked at is if you bid a job and you had a 3% contract on a $5 million job, if you have change orders that drive that up to a $10 million job, if that percentage goes from 3 to 2, you could still be considered to have a profit fade. And the case I gave just then is a double the size of the contract. That's kind of extreme, but generally speaking, you want that percentage. Generally, what is seen in the market is change orders have higher profits than the original, so you want to see that number start going up, your gross profit percentage, as the change orders occur.
So another question that came in that goes along the lines with that is, are the surety companies and the banks, are they good about understanding the ebbs and flows in the overall economy being taken into account when they are looking at our profit and potential fade?
I would say, from my experience, absolutely. They
yes.
do know. In 2009, if you didn't have red ink, you were the exception.
Okay. Another question, and how do we define overhead?
Overhead should be it should not include your indirect costs, which would be equipment repairs, your shop, things of that sort. Overhead should be truly your office rent, your utilities, your telephones, things that would not change. Generally speaking, they're not dependent on the number of contracts you have in place. they should be fairly stable always. You're going to have a bookkeeper. You may have a receptionist. Those things that are not going to increase, such as laborers, project managers, supervisors, equipment, with the quantity of work you do. Now, that's kind of relative, because if you doubled in size in the period of a couple of years, your overhead would naturally go up some, but it should be a fairly stable number at the point you reach a kind of a stable revenue stream.
Now, we've had a couple of questions around the same issue, and it is, are there industry standards, and if there are, where can I find them for net income as a percentage of revenue from both a GC standpoint and or a subcontractor standpoint?
CFMAA website has a lot of things that will give you kind of benchmarks on things you should get, or goals that you should strive for, kind of some rules of thumbs. However, what I find is that your net income is going to fluctuate for various things. If you have a very profitable year, often you have the owners that are being generous with their project managers and themselves with bonuses, so that's going to drive the net income number down. I think from what I've seen, also what you see is when things happen, such as the recession, is you have more, if you're in a bid market or even in general, the gross profit numbers tend to start going down because you're trying to get work to keep your workforce busy. So you have increased competition, which drives the cost down. So it's going to depend on the market. So there's not one answer there that I've seen. And in fact, generally what I see is the surety companies are not half as worried. They want to see profitable companies, but they don't want surprises more than anything. They want a good, strong working capital. They want good, strong equity. They want all the things we talked about at the beginning in place, because profitability can be subject to, if your tax method is different from your financial statement method, you may have to do things to limit your tax liabilities, or to try to reduce them as much as legally possible. So from that, I've seen contractors who were very successful but had a loss because they bonused so much money out of the company simply because that was cheaper than paying the tax liability they were going to be faced with. So gross profit margins are going to vary depending on how good the economy is and how plentiful work is in your area. From what I've seen, it's also if you have your overhead and things in place to where they're constant, you should know what you need to make on a project. It's kind of an individualistic thing.
Okay, thank you. Kelly, this one goes back to one of the slides that you had, which was, you talked about equipment utilization to watch. Mm-hmm. Do you know of any tips that might help a contractor do that, i.e. any technology solutions, or just any tips in general about how you can check up on your equipment utilization?
Oh, Larry, do you know of any technology solutions that might help?
Generally, what I recommend to contractors, if they identify their indirect equipment cost, your goal is for your allocation, much like your labor burden, you want to make sure your labor burden is capturing all of the costs that would be related to your employees, such as health insurances, payroll taxes, workers' comp, general liability, anything that's feeding off that, to make sure that your labor burden is capturing all those costs. Similarly, that's what you want to do for your equipment. If you are charging equipment and you've set certain equipment rates for each piece of equipment and are tracking it on a timesheet, much like an employee, to make sure that you are capturing the time that it is on each job, you want to charge that back to the job. Your goal is, at the end of the year, whatever your equipment cost that was allocated offsets your repairs and maintenance, your depreciation, your interest expense on that equipment, your any other costs related to that, gas, oil. If you have a shop, what you're trying to do is allocate those costs back to those jobs and make sure that you're getting pretty close.
Okay. A couple last questions. Larry, way back on one of your early slides, you talked about underbillings on your balance sheet as related to net working capital. Mm-hmm. How do you find the surety companies try to drill down on the number that's on the balance sheet for underbillings?
Well, there should be a contract schedule with your financial statements. In ours, we have supplemental schedules that the surety markets want to see, and they're going to look at your jobs in progress or your work in progress schedule. Oftentimes, the ones in our area, the sureties request a work in progress schedule with your in-house financials to look at it. If there is a significant underbilling, particularly if it's not the norm, they will start having you document a lot of reasons. They will be checking on that job, requesting what's going on. They're going to start by saying, is there, what's going on with the job? Why are you underbilled? Why are you not able to bill for the cost that's in there? And follow up aggressively, or they will discount that number because I recently had a contractor client who was overbilled on every job but one, and they had a significant underbilling there. And when we were doing the audit, of course, we had to look into it very carefully. And the surety company had already been, when they submitted their in-house financials, to look at it and to pour through that job, go look at the job and all that. So once again, I said it depends on the size of the number. If it's usual I have certain clients that the type contracts they sign often creates underbilling, so that's not going to be a big a deal. But if you have one that stands out or one that's really large, in most cases, there shouldn't be a significant underbilling on a contract.
Okay, I think we've got time for two more questions. The first one is with regards to creditworthiness of a new client that you've never dealt with. Do you find that anyone finds it worth the time and effort to do background checks on the principals of the new client? And do you know if that is generally done in the industry, and has anybody found value in it that you've talked to?
In my experience, it depends on the type entity it is and who the reputation. If it's a new entity and people aren't familiar with the players, a lot of times I have seen their inquiries done on the owners as well of the entity, because right now there will be these LLCs that pop up to build, let's say, a commercial office building. And so those LLCs that are formed, if you don't know the players in it, they may be formed just to hold one particular development or one particular building. And so a lot of times it is necessary to find out who the owners of that LLC are and determine what their reputation and creditworthiness is. There are certain developers that don't have good reputations, and they repeatedly form these LLCs for a development project, whether it be a mall or a commercial building, a hotel, and it's prudent for you to do whatever you feel necessary to have confidence that those people will pay your bills. You certainly don't want to pay someone to build their building.
Okay.
I have seen the same thing in my area too.
Oh, I'm sorry, Kelly.
I was just
Kelly,
confirming. I have seen the same thing in my area too. Yeah, I would definitely look to the owners or members and their creditworthiness.
And I would say in our area we do find that people have started doing this more and more often because of exactly what Larry laid out. And unfortunately, there are subs that kind of come and go, but the companies may come and go, but the principals are involved in other entities, and so we have found several clients who've started doing cursory background checks on the principals. Our last question, it's a little involved, so I'm going to read it, and we will see where this one goes. When it says, you say that generally change order margins are higher than they are on the original bid, what if we're a sub through, and sometimes the GC and the construction management contracts we sign limit the subs to 10% overhead and 5% profits? These contracts go on to define overhead to include project management, on-site supervision, engineering, estimating, accounting, administrative costs, and pretty much anything other costs which are technically project costs. If we include all of these costs as overhead, our overhead alone can be roughly 15 to 17%. Therefore, the construction management contracts are preventing us from being able to make a profit on change orders, since they are only willing to pay 10% overhead and 5% profit. Are any other subs that you know of seeing this? What is the best way for a sub to to still make a fair profit on change orders when this happens?
I would say that irregardless of overhead is what overhead is, regardless of what a contract says that you can bill for overhead in your 10%. So what that will do is if you can bill 10% to cover your overhead, it will still show up in your project, in your job costs, in your gross profit in the correct way, or it should. The second, to answer the question about ensuring, what I was referring to when I said that in most cases or many cases, what I see is a higher gross profit percentage on change orders than the original contract. I was referring to looking for profit fade. So if you're limited to the same gross profit number and overhead percentage number on a contract for all change orders, you should not be showing a profit fade. So that's the overriding goal, is that we don't want to show that it would be consistent and you're not elevating your profits. So how you can ensure that is, I would think, would be not signing a contract that you felt was precluding you from getting the profit that you think your company needs to thrive and survive. But I know oftentimes if it's going to lead to bigger work, I do see people who will take a less advantageous contract in the hopes that they'll get more work with a certain customer. But that's one of those things to be aware of.
Okay, well, I think that wraps us up. And once again, we really appreciate everyone taking the time to attend this webinar. We try to do these in various industry lines to keep you up to date with current thinking and trends. Kelly and Larry, thank you so much. You will have in one of your screens their information. Please feel free to reach out to them with any other questions, or myself. And we look forward to seeing you at future webinars. And thank you very much for coming.